Well, hello everyone and welcome. This is Cynthia Tomane with Interactive Brokers. Oh, hold on. Looks like we may have a bit of feedback. Okay.
Oh, sorry,
Right.
I unplugged the speaker, Cynthia. Sorry about that.
Oh, okay. Sounds like our speaker and the feedback in the background. Well, thanks, Tariq. Well, let me take a quick moment to introduce Tariq Dennison, who is going to be our speaker today. Tariq is a wealth manager and investment advisor with GFM Asset Management. Tariq, take it away.
Thank you, Cynthia. Okay, so I see you should be seeing my title screen there. As Cynthia mentioned, excellent. So the title of my presentation today is India After COVID-19, and I should actually probably say during and after COVID-19. This is an update for offshore investors into the world's largest democracy. So namely, this is for investors outside of India who cannot directly access Indian cash, stock, and bond markets, and so might be looking at instruments, for example, the SGX-listed Nifty futures contract or SGX-listed Indian rupee futures contract, as well as offshore funds for accessing the Indian stock and bond market. So before we begin, I need to present two very important disclaimers. Excellent. So with those disclaimers out of the way, for those of you who may not know me, I want to just briefly introduce myself again. My name is Tariq Dennison. I am a trust and estate practitioner, certified financial planner, and wealth manager based here in Hong Kong. And I run a Hong Kong and US-based wealth management firm where we manage accounts as an advisor on the Interactive Brokers platform. You can see our US advisor account and Hong Kong advisor account names here on this title slide. I have been in the market since 1998, so trading stocks, bonds, and currencies at 5 different top-tier investment banks before starting my wealth management firm, GFM, here in Hong Kong in 2012, and then later on 2014, 2016 for the different entities. I have a master's in financial engineering from the University of California at Berkeley, and I'm a visiting lecturer at Essex Business School in Singapore on fixed income and alternative assets. My main focus is on the US-Asia corridor. So I have spent a good chunk of my career helping US-based investors invest in Asia and Asia-based investors invest in the US and vice versa. The title of my first book so far, is Invest Outside the Box, Understanding Different Strategies, which includes a section on international markets, including India. So what are we going to cover in this presentation? This presentation can be thought of in two broad parts. One is going to be about fundamentals of India, of the Indian stock market, the Indian rupee currency, the Indian economy, things that you're going to need to know about India. So I'm going to start by talking really about the hottest current event, which is India's corona test or COVID-19 test, basically how India has been handling the outbreak so far and what is an outlook for how we could expect it to handle it going forward. Some key statistics on why invest in India or why look at India as a market, whether long or short, but big numbers which are definitely too big to ignore. Next, as mentioned, I'm going to be talking about the Indian rupee as a currency, Indian interest rates, and the Indian economy. Then diving more specifically on the Indian equity market, specifically the Nifty index, breaking down what's in the Nifty, what makes it up, what are some of its fundamental metrics, and how you should decide whether you might want to go long or short or how much of it to allocate to your portfolio. Then in terms of actionable trading strategies, I'm going to talk first of all about the Indian rupee currency and how to trade rupee currency futures as a strategy for different types of things that you might want to do, whether it's hedging, whether it's momentum strategies, and so forth. Next, I'm going to talk about the India Equity Index Futures, the Nifty futures contracts listed on the Singapore Exchange. I'm going to compare these versus ETFs that you might be familiar with for accessing the Indian market and present ideas for directional as well as long-short hedged strategies that you might consider using these futures contracts. Of course, no discussion about trading strategies would be complete without discussing risk factors. So I'll make sure to include some of those at the end as well. So first of all, let's talk about the the pressing centerpiece, the title of this, and the main thing that I am updating in this presentation compared with any of my previous India presentations you might have heard before. And that is, how is India faring with its COVID-19 test so far? So if you've been following the story, you might have seen back in late March a video, an address made by Prime Minister Narendra Modi addressing the country about a 21-day lockdown, a 21-day curfew that was going to be applied nationwide from that day in late March. I remember that time quite well because that was right when I came back from Singapore and had to do my 14-day quarantine here in Hong Kong. But if you get the chance, I've included the link here on the side. If you have not watched that address already, I highly recommend you go back and watch it. Comparable to the ones by Prime Minister Lee of Singapore, I believe it's been one of the more compelling COVID-19 addresses we've heard this year so far. The one title that I wanted to include here specifically was the statement by Prime Minister Modi: if we are not able to manage this pandemic in the next 21 days, the country and your family will be set back by 21 years. The reason I like that particular segment was that it highlighted what a long-term perspective needs to be taken about the impact of something like this, a shock like COVID-19, has on the long-term prospects for the Indian economy, the Indian market, and investing in India. I sometimes say, like, if you think of it like a particle accelerator, COVID-19 smashed a lot of economies and lets you look at a lot of the different parts of it and see how different parts of those economies have fared. So this was already about 3 months ago. We're now in the middle of June. Let's take a look at some numbers on how it's fared since then. There are lots and lots of different statistics which you've probably seen. This one is already a few days old, but this was one that I chose to highlight to just give an idea of where India is in the COVID-19 cycle relative to other countries so far. So no doubt this is one of the big stories of 2020. COVID-19 really started, to everyone, obviously started in mainland China, really started in fact, even in Hubei province. Throughout January, most people seemed to think it was purely a Chinese disease, purely a Chinese problem. And it was really only much, much later in February, in March, where you started seeing cases overseas and then deaths overseas. So what this chart shows is that where it really took off before anywhere else was in Italy. Italy, basically, you can think of northern Italy almost having become the second Wuhan or second Hubei province for where it took off. And the reason I'm including it is basically to show how it took off in Italy, just as deaths were starting to come down in mainland China. Then it took off in the US, and the big market crash of this year happened in March when the panic really set off in the US. And with all the stereotypes, you think of traders in Wall Street thinking of this finally hitting home and initially overreacting to what the panic's going to be, the Fed coming in. And this one basically shows that the US has been a few weeks behind Italy in having its cases peak, but eventually deaths from COVID-19 in the US surpassed those of Italy. So really what I want you to see in the red, the green, and the blue cycles here is how the different peaks of those three different countries in terms of COVID deaths, now again, this is not COVID cases, basically came in sequence. So now the US hopefully has passed its peak. Hopefully we're not going to see a second wave. But what I want to highlight here is that cases in India and deaths in India are, for better or worse, still rising. From the visual of this chart, if you wanted to say a chart says 1,000 words, the first 100 of those words you could say is at least it seems that India has been better at flattening the curve, at preventing an initial spike in cases and deaths compared to countries that had much, much lower populations. So right now, as of this morning, India had the 4th highest number of total cases of COVID-19 after the United States, Brazil, and Russia. And those three countries combined have less population than India. So if you want to talk about flattening the curve, at least so far, India seems to have been doing something right. So the real question in terms of how well it's handling it going forward is, can it keep that curve flat? Will the number of deaths eventually peak out? And will it ultimately be able to stop? Obviously, the structure of India, the structure of how people live there, between cities and villages and migrant workers and conditions in slums and so forth like that, are all very, very critical components to that very, very, very complex question. But there was a very recent story that I feel is worth highlighting about how well COVID-19 has been handled in one of the poorest slums in India, with workers going in and testing actually lots and lots of slum dwellers, for example, and how that needs to be extended to all the different migrant workers going to different villages and so on like that is really nothing short of remarkable. And I have to say, as an American myself, I find it difficult to compare with what we've seen in the U.S. as far as testing and case handling and so forth. But obviously, that's one thing that is very difficult to compare country to country, especially in countries with such different economies, different governments, different customs, and so forth. But that was 1,000 words for this particular slide and this particular chart. I hope it at least gave a clear idea of where these 4 countries are in their relative points on the COVID-19 death cycle, if you want to call it that. So now breaking it down a little bit further, even though we can chart total number of cases and total number of deaths per country, it really becomes a little bit more nuanced when you go down to the level of individual states and cities. Now, what might not surprise most of you is that, like in many other countries, like if you look in London or in Wuhan or New York City, the biggest outbreaks, the biggest cases of these tend to be in places that are very, very crowded. And these COVID-19 tends to not have been as much an issue in places that are less crowded and more spread out and more rural, for very obvious reasons. In order for this to spread, we have to get close to each other, we have to sneeze on each other, or I have to sneeze on something and you would touch it. It's quite contagious in those conditions, but in places where it's easier to socially distance, we don't see it spread out as much. So what this map shows is which Indian states have had the biggest number of cases. And this, again, is slightly dated. This is from earlier this month. So the 4 places I really want to highlight here are the capital of Delhi, the state of Gujarat, the state of Maharashtra, where the city of Bombay is, and Tamil Nadu, where the city of Madras or Chennai also happens to be. One of the places that's often highlighted for handling it well is the state of Kerala, which is all the way on the southwestern part of the country, right next to Tamil Nadu. So if you're interested in seeing how different states of India have handled it differently, there are a lot of cases you can look at state by state rather than looking across the entire country. And as you know, that I am very much an investor who likes to look at specific cases rather than trying to generalize across entire countries or entire indices. So that's my attempt at trying to summarize what the situation is with COVID-19 in India. Basically, the acute COVID-19 test, the shock test that India is going through right now, and we should be watching for the course of the year. Now, beyond 2020, longer term, we want to look out to 2030, 2050. What is the case we should be making for India? Should we be thinking of India as possibly the next China, or perhaps the next, what's a good example there? The next Argentina, or what other example would you like to make? So for this, I like to look at a longer-term history and some longer-term statistics to put some perspective on what sort of long-term trajectory India is on after COVID-19 is over. So those of you who would have attended my earlier India presentations would have seen this slide before, and of course, those of you familiar with Indian history will probably find this quite familiar. I am based here in Hong Kong, and really what I want to do is I want to compare 3 different major areas of British colonial rule. Hong Kong was a British colony right up until 1997, and then there was a handover, and we are now the Hong Kong Special Administrative Region of the People's Republic of China. Why am I saying this? I want to compare Hong Kong with another former British colony, the one that is the base of the exchange, which we're looking at as a trading venue, and that, of course, is the Strait Settlement, which from the late 1950s to the early 1960s spun off into the colony of Malaya, and then in 1965, Singapore gained independence from Malaya, and we now have 2 sovereign states that came from the British Strait Settlement. And Singapore, of course, is one that I've spoken about in several different events as one of the most successful former British colonies on this side of the world. Now, the next slide, the reason I saved the other half of this slide for is to show what happened in the Indian subcontinent. So, as we see here, the colony of British India, it contained actually many different sovereign states. If we look over to the right, we'll see that a separate colony of British Burma was spun off in the 1930s. Now, this wasn't really considered a sore spot. It wasn't considered a part of partition. But for those who look at Burma or Myanmar as an area of investment, I do find visiting there that there are lots of similarities to what India used to be like. Burma kind of reminds me of what India was 20 years ago, so that's looking a little bit into the past. So I include that here because that is part of the broader greater Indian subcontinent, not to be ignored. Over on the left, you'll see the Trucal states, which later become the United Arab Emirates. Many of us now are way too young to remember, but yes, that was part of the British India colony. And you could have, back in the 1920s, traveled around the Persian Gulf using the Indian rupee as your currency. Going further down, it was in 1947 that India not only gained independence, but was actually partitioned into two separate countries, India and Pakistan. Pakistan later had a civil war in 1971, which split it off into Pakistan and Bangladesh. I have largely talked before that for some reason we don't look at India, Pakistan, and Bangladesh the same way that we look at, say, mainland China and Taiwan, even though these are, of course, countries that should be trading a lot more with each other, have a lot more economic interests in common that should be looked at overall. But of course, you can tell I'm an optimist about the overall region, and I'm really just trying to look for where there's investment opportunity. I've also included here, kind of tucked under all of this, the colony of British Ceylon, which became Sri Lanka. And whenever I mention mainland China and Taiwan, I sometimes also get asked, well, should we think of Sri Lanka as India's Taiwan in a way? Obviously, I mean that in a business and investing context rather than any other context, but I'm really providing that as food for thought more than anything else. Down at the bottom, with India having the biggest flag here, I also want to mention that the independence and partition of India didn't really stop in 1947. Those of you who followed and know that India has actually split up and kept creating more and more states without actually adding more and more territories. So last I checked, and this was only in 2014, India now is made up of 29 different states and 7 union territories, and that was since Telangana split up from Andhra Pradesh in 2014. So that's a brief summary for those of you who may not have been familiar with the recent history of India, and hopefully it was useful. So as mentioned, the UAE was spun off of the Trucal states, which were part of the British India colony. So that's about the past. That's kind of giving you an idea of how was India different than Malaya, Singapore, Hong Kong, as far as its colonial history goes. What does it mean in terms of what it is as an economy? Its government, how is it ruled? Is it capitalist, communist, and so forth like that? Well, here I often say it's a tale of 3 prime ministers, in long sequence. The first one, of course, is Jawaharlal Nehru. So one of India's earliest prime ministers, and really what I want to highlight here was a Soviet stamp of him, written in Russian, printed back in 1989, but basically praising Jawaharlal Nehru for his socialist principles. And the quote that I've often said was associated with Nehru was once he told an economist, "Do not talk to me about profit. Profit is a dirty word." And you may seem like I'm being very, very hard on Nehru here, but I will often say that the socialist attitudes and socialist policies of Nehru are sometimes attributed by economies and historians for India's relatively low growth rate for 40 years. And you have to consider how critical it was an economy the size of India's, which was considered to be one of the most promising economies at the end of World War II, grew at less than 3% for 40 straight years. Meanwhile, countries like Singapore, countries like South Korea became far more prosperous and far wealthier on a per capita basis than India did. Now, I mentioned for 4 decades. What happened in 1991 was another Prime Minister Rao, made very significant reforms and very significant liberalization of the Indian economy. And those of you who are about my age and older will very much remember this and will very much think of this as really changing the trajectory of the Indian economy, much as what Deng Xiaoping did in mainland China changed the economy of mainland China. The main thing I want to highlight here is moving from profit as a dirty word to the end of the license Raj. And what I've understood when I've studied, what was it like to run a business in India in the 1970s, it was lots and lots and lots of red tape. Basically, there were requirements for enormous amounts of licenses. It was very difficult to fire people. It really was not a very easy place to run a business at all. So just as we might say that 1947 was the twilight of the Raj, meaning the British Raj, 1991 was the twilight of the license Raj. Basically a reform that was supposed to make it easier to start and run businesses as an entrepreneur. Now, for the next 25 years or so, we saw India's economy grow and questions coming about whether it was going to be the next China. The next major thing that I wanted to highlight was the Prime Minister that India has now, which is Prime Minister Narendra Modi. Now, one of the main things I want to highlight, believe it or not, is that he was the first Prime Minister born in an independent India. So it gives you an idea of the kind of age of leadership and how much can linger on for periods of time. But certain shocks that Modi has gotten done in his time in office was for GDP growth to surpass the GDP growth of China. And I'm going to mention in a later slide, what makes India so attractive is not just that it's so big, but it's now big and growing faster than China. So it's that catch-up story which really makes India quite attractive long-term. 2016, India also shocked everyone with a sudden demonetization, basically suddenly saying that 1,000 rupee notes were suddenly no longer valid legal tender. And it was all done by surprise, and it was all done right when the U.S. was paying attention to the election of Donald Trump. Caught a lot of people by surprise. Some people think it was great for stamping out corruption. Some people wonder what it means for the future of a currency like the Indian rupee and convertibility and openness of the market. I'm not going to comment on that, but it is another event that's worth studying if you're interested in. Also, in 2017, we saw significant tax reforms, the attempt to unify several different consumer taxes across India, which, again, I haven't been there as much since 2017 to follow the difference, but from what I understand, again, it's easier to run a business there now than it was 10 or 20 years ago. So in terms of regimes of market development, this is how we got from less than 3% growth to over 7% growth in the Indian economy over the past 30 years. So statistic number one, as mentioned, India is now growing faster than China. The charts that I have here show the economic growth rates, the year-on-year GDP growth rates of the United States, the People's Republic of China, and India. And when I last took this snapshot earlier this year, it was showing not only that India's GDP growth rate was 7 versus China's 5.8, so over a percentage point higher, it was also showing the IMF's projections of continued higher growth in India than in China. And that's not surprising, given that India is still significantly poor on a per capita basis and simply has a longer way to go on a lot of low-hanging fruit develops that we can expect from it over the next few years. Any of you who spend significant amounts of time in India and mainland China probably know exactly what I'm talking about. In terms of long-term absolute GDP, this is a chart that I find quite thought-provoking. And here, what I want to show is what I call the juice economies. If you've read my blog posts or articles or seen my earlier presentations, you know that I use the acronym JUICE, J-U-I-C-E, to refer to the 5 largest economies in the world: Japan, the US, India, China, and Europe or the Eurozone. And here what I'm showing is what has been the economic growth of these 5 juice economies since 1960. Now we'll see that over most of that time, not surprisingly, the US and Europe were the largest and wealthiest economies. And for really right up until about 1990, we saw Japan having this remarkable roar, this remarkable catch-up story. I mean, obviously Japan was the place to be, the place to invest through the 1970s and then through the 1980s. Since 1990, 1995, the remarkable economic growth story was that of China. One thing I hope is remarkable about this chart is as recently as 1987, the economies of China and India were the same size. And remember, this is a log chart. These 2 economies went from being the same size to China's economy now being 8 times larger than India's economy. So that's looking back over the past 30 years. The next question is, what do we expect over the next 30 years? India surpassing Japan, India catching up with China. Some of those I'm going to be showing all the way out to 2050. So shorter term, going back to a near-term snapshot, I'm talking about really, really long term, and of course, many of you are probably asking, yeah, but what about this year? You know, I'm hearing about contraction, negative growth in some different markets. Well, at least according to this, GDP growth for fiscal year 2021, at least according to this forecast, is still expected to be positive, which again I think is quite remarkable. You know, not having a recession, but revised down to 3.6% from 5.5%. So still quite a bit below that 7% target. That's the idea of the shock we're talking about. I don't put too much emphasis in 1 year, especially an exceptional year. The real question I want to ask is, are we back on trend? Should we expect India to go back to 7+% growth rates and keep on that line that we were showing on the previous chart? The optimist in me says, sure, there's a good reason to expect that, provided a lot of other things don't get messed up. Statistic number 2 I want to highlight is demographics. So one thing really not to overlook, we can look at GDP numbers and just project them out and take averages, but the fact is you can't have economic growth without people. If you look at Japan and you ask, well, why is it that Japan's GDP hasn't grown? Well, actually, for the past 15 years, Japan's population has been declining. So even though Japan's GDP has actually been roughly flat, on a per capita basis, Japan is actually not doing too badly. It's because it's taking the same amount of economic activity and splitting it among fewer people. Now, what's the case with China? Within the next few years, according to this chart, by 2027, China's population is going to stop growing. China's population is going to flatten out and it's going to start declining for obvious reasons, namely the one-child policy. And even though, as you know, the one-child policy was abolished a few years ago, the fact is you don't see a lot of Chinese families having more than one child anyway. In fact, you're seeing record numbers of Chinese women in their 40s who have never been married, don't want to have kids, and this is not a unique phenomenon. The fact is it's still a much bigger problem in China than it is in India. India is a significantly younger country than China, and I'll show later a little bit about the workforce. And that is very, very important, both for how well it survives COVID-19, for how robust its workforce and economy is going to be over the next 2 years as far as keeping pace and overtaking China, and then ultimately in having a larger overall population. Larger overall population, even with, say, half of the GDP per capita of China, is quite a bit of catch-up ahead of it. According to this chart, India's population is not likely to peak until around 2060. Of course, that's based on certain assumptions, and we can all speculate about what family sizes and number of children per woman is going to be in 2060. But it's a statistic I'm very, very interested in because it is very, very important to our economic futures and our children's economic future. So statistic number 3 is the size of India's economy versus China and the United States. And really what I want to show here, this is from a PwC survey in 2014, comparing the 5 largest economies in 2014, 2030, and 2050. And the point of this slide really is to take PwC's projection out to 2050 and highlight that by 2050, PwC expects the Indian economy in purchasing power parity terms to be larger than the US economy. Now that's, again, in absolute terms, this is not per capita. But now let's look at per capita and see what that means. We'll look at per capita later. When I talked earlier about demographics, part of what we were talking about in terms of population growth was absolute population growth. I also want to talk about that economic growth being driven by not just more people, but more working people. So what this chart shows is some of the world's largest economies and which ones of them have growing working age populations versus which of them have declining working age populations. You'll notice on the right that Japan, China, South Korea, Italy, many countries that are now some of the world's largest economies will face the headwind of having a declining workforce over the next 30 years. Whereas on the left, many of the countries that I'm most bullish on are the ones that we expect to have larger working age populations. Now, of course, just having more workers by itself doesn't generate economic growth. You have to both make sure that those workers are employed, and not just employed, you want them to be employed at something productive. You don't want a scenario where you're just having them go dig ditches with teaspoons just to give them jobs. You want to make sure that they actually have productive jobs that make the economy more productive. Now, fortunately, on this list, as you will see, India is number 7, right after Malaysia and right ahead of Bangladesh in terms of expectations for growth of working age population by the age of 2050. So in my view, a centerpiece of your or bear case on India will have a lot to do with how productively that growing workforce will be employed in the Indian economy over the next 30 years. So this was the chart I was highlighting about earlier, which is about gains in GDP per capita. And of all the charts that I mentioned so far, I think this is one of the most significant in terms of increased standards of living. Because if you look all the way on the left, it's impressive, but probably not so remarkable as when you go on the right. The United States right now has a GDP per capita of around 57,000 US dollars a year, and over the next 30 years, that's expected to roughly double. Basically expect, double standard of living for the average American in that time. And what does that mean in terms of self-driving cars, quality of televisions, quality of home? What does it really mean in terms of quality of life for the average American? I wanted you to contrast that all the way on the right with India, which currently has a GDP per capita of only 2,000 US dollars per year. Now, what does that mean in terms of the way the average, now again, this is the average Indian, not the average urban Indian, the average wealthy Indian, the average Indian, how they live today in terms of what they're able to afford, what standard of living they have, how they get around in terms of transportation, what job they do. The projection is that by 2050, the average Indian, the average GDP per capita will be 22,000 US dollars a year. That is an 11-fold increase versus a 2-fold increase. So that is the significant, I would say the most significant ratio, or the most significant number of the ones I'm looking at here. If you want to make a bear case on India, start by attacking that number and saying that India is going to stay poorer than PwC is projecting in this particular report. As mentioned, some of these charts are from a specific PwC report that I've included a link in here if you would like to take a look at. One other difference between India and China, and I know that the two are often compared, but I think it's really important to highlight with this specific chart, and that shows the split between agriculture, industry, and services in the Indian economy. Those of you who followed the miraculous growth of the Chinese economy over the past 30 years know that it is largely a manufacturing story. If you look at the great fortunes made in China, the largest companies there are basically manufacturing companies and the banks that finance them. That would be the blue line in this chart, but what we see in India is that India has already, even in the mid-2010s, become a predominantly services economy. In that way, it already looks a lot more like the US than China does. China, in some ways, looks like the US in the 1950s, when it was really big at manufacturing and coal and a lot of these heavy industries, whereas India already looks very much like a services economy. So again, part of the projection of how well employed that average Indian is going to be is what types of jobs are they going to be doing, and how productive are those services going to be, both domestically and in service export sectors. Statistic number 7 I want to talk about, and this is going to be important when we talk about the Indian rupee as a currency, is interest rates. One thing that many of us who invest in bonds are already quite frustrated in is the interest rates around the world have plummeted. They are virtually zero in most G7, most major currencies. Even longer-term bond yields, 10-year US Treasury right now yields you 0.5% to 0.7%, depending on which day you look at it. By contrast, India is one of those economies with a large bond market that still has relatively healthy yields. Now, obviously, that's due to higher inflation, but you would say, due to demographics, that's still a relatively healthy short-term interest rate and relatively healthy bond yield. I'm not necessarily saying that you just want to take currency risk just to take advantage of that high yield, but the short answer is it is a carry trade, and we will see that when we look at Indian rupee futures if you want to try to capture this higher interest rate using those futures contracts. So on to the currency, on to the Indian rupee. So as with everything, I like to start with a little discussion of history, usually a long-term chart. So in this case, I am plotting the Indian rupee versus the Chinese yuan, renminbi, going back to 1971. So 1971 is when Bretton Woods collapsed, when currencies started free-floating. And a little-known fact at the time was that throughout much of the 1970s, the Indian rupee fluctuated up and down, but it was actually a relatively stable currency throughout the 1970s. Finishing the 1970s, around 1980, I remember it being around 8 rupees to the dollar. Perhaps just as surprisingly, during the 1970s, the Chinese yuan renminbi actually strengthened. In 1980, it was around 2.5 renminbi to the US dollar. Now, over the course of the 1980s, many emerging market currencies, and this is across what we now consider emerging markets, devalued. So we saw significant devaluation throughout the 1980s, and then throughout the 1990s. In the mid-1990s, the renminbi actually pegged itself at 8 to the dollar, while the Indian rupee continued to devalue. Those of you who follow the Indian rupee for a long time will remember its path from 8 to 15 to 25 to being in the 40s throughout the mid-2000s, and then it broke through 50 and then 60, and now it's around 75, 80. You know, it's really kind of breached through there. Whereas the renminbi, after a long period of being stable around 8, started strengthening and is now considered a relatively strong currency by comparison. So this is really, in many ways, a tale of two currencies. And even though both currencies are emerging market currencies and very heavily managed by their central banks, they definitely have very different histories of devaluation versus pegging. I also wanted to go back a little bit further, looking at the absolute exchange rate, because as I mentioned, I really only started following the Indian rupee from the 1980s, when it was around 8 rupees to the dollar. This goes all the way back to 1957, when it was around 4.5 rupees to the US dollar. You know, believe it or not, there were a lot of other exchange rates back then which might seem a little bit strange. 50 Korean won to the US dollar, 2 Philippine pesos to the US dollar, for those who would go back all the way to the 1950s. But this is a long-term chart, really just giving you an idea of the long-term devaluation trend of the Indian rupee. So short-term, I would say overall, we consider the Indian rupee to be one of the depreciator emerging market currencies, but there are periods of time, like in the mid-2000s, where it holds steady or even appreciates, and with a higher yield, that can provide opportunities for short-term carry and momentum trades. So if you want to trade the Indian rupee using offshore futures, so let's say you're like me, you're based in Hong Kong, you're based in Australia, or you're based in the US or any other place, you can trade the Indian rupee using currency futures contracts listed on the Singapore Exchange. And this is a screenshot that I'm bringing from here. These contracts are really pricing, so they're not the way that you're used to seeing them. They are basically the price of Indian rupees in US dollars, so it's quoted inversely. And what you'll notice here is that when you go to future months, so when you go from June to July or July to August, these futures trade at what's called a forward discount. So in other words, to buy rupees for August delivery, you're actually going to pay a lower price than buying rupees for June delivery. And that's because Indian rupees have a higher interest rate, and you're basically earning that higher interest rate by buying rupees further out than you would. Now that said, I'm talking about buying later months. You will notice that most of the liquidity, as with many futures contracts, is in the front months. And I've included here both the T session and the T+1 session, the overnight session, in case you want to compare the relative volume of the two. But the point is that even if you wanted to trade a month out, I took this screenshot about a month ago, even about 2 months out, there still was liquidity in the July. So if you don't necessarily want to roll this every month, you can buy a little bit further out, lock in effectively that interest rate differential, and get that position that way. If we look at the history of this, how did the Indian rupee perform during that stress test earlier? Well, again, as I mentioned, the Indian rupee is an emerging market currency. It's also, it tends to sell off when there's risk off. You can consider it a risk asset. Pretty much the same way like any high-yielding currency, any high-yield bond, any other high-yielding asset, when people panic, when the markets sell, the S&P goes down, the Indian rupee goes down. Just broadly, that's the way that it works. So as we saw in March, we saw a significant decline in Indian rupee futures, followed by a recovery quite similar to what you would have seen in high-yield bonds, equities, and other risk assets. So if you're trading this on Interactive Brokers, you're going to see a screen more or less like this. So the example I wanted to show here was to sell one June contract, and I showed a price here. And you'll notice the multiplier. So one June contract has a notional value of around 26,000 US dollars. So compared with other currency contracts, which are usually around $100,000, it's not a huge contract. And so in that way, it's actually quite useful if you're actually using this for, let's say, hedging purposes. Let's say you're looking to buy a house in India and you're worried that the rupee is going to go up between now and when you're able to wire your deposit back to India or something like that. Well, this would be one way of locking in that exchange rate over that period of time. I also show in the lower right-hand section of this what the impact of margin is, so how much margin you're effectively using by trading one of these futures contracts for this particular account. So again, you see the ticker symbol here is IU, you choose your month, and it's pretty much like trading any other futures contract in our Interactive Brokers accounts. So that's enough for the Indian rupee. Now let's talk about the equity index, the Nifty index. So when talking about an index, I like to open the bag, look inside, and see what's in it. And for those of you who are familiar with Indian brands are probably not going to be too surprised to know that the Nifty index is, to some extent, a who's who of publicly traded Indian companies. And this is across sectors. So of course it will include banks like ICICI and HDFC, but it will also include Infosys and Wipro, which are in the IT sector, Tata, which is Tata, Maruti Suzuki, which are they make cars and trucks. They include healthcare companies like Dr. Reddy's and Sun Pharma, Reliance, Power Grid. So in many, many ways, it's a blue chip index of 50 companies. You compare it to, say, the FTSE 100 or the Dow Jones Industrial Average. If you've heard my presentation on the China A50, you will notice that in some ways the Nifty 50 is actually a more diversified index than the A50 or the Straits Times Index. Those two indices actually being far more heavily dominated by financials compared with the Nifty. So in terms of sector breakdown, you can get the sector breakdown of the Nifty index by going to the NSE page or to really any other page which will give you information about the Nifty index. Whereas one half of the Straits Times or one half of the A50 is in financials, 1/3 of the Nifty is in financials, which, depending on how you look at it, could be good, bad, but probably not too bad as far as an emerging market goes. Those of you who've seen my other presentations know that one of my big irks about a lot of emerging markets is a heavy allocation to financials, whether or not you like it. But the other sectors that are heavily represented are information technology, oil and gas, consumer goods, and several other industries here. And you'll notice on the right, what are the top companies? Reliance Industries, HDFC Bank, Infosys. These, again, are companies that you're probably fairly familiar with if you follow the Indian stock market for some time. I also included a snapshot of the fundamentals, but please note again, this is old data taken from a single screenshot of the NSE back when the index was trading at a price to earnings ratio of 22.3 and dividend yield of 1.5%. As far as emerging markets go now, that actually makes the Nifty relatively expensive by just those metrics, at least when you compare it to China or South Korea or other markets that are trading closer to 12 times earnings. So that's one thing to keep in mind, although do know that for that, you are getting companies like Tata Consulting, Infosys, which are not all just, say, banks and heavy industry and other companies which some say deserve to trade at higher PE ratios. I also do want to mention here, because I don't have a separate slide on it, there is a Nifty index and there's also a Nifty Banks. You will find on SGX and on Interactive Brokers a Nifty Banks futures contract. So if you want to specifically isolate out financials, you can either trade Nifty Banks directly, or you can buy Nifty and short Nifty Banks to try and isolate out that exposure, at least until we have an India X financials or an India sector futures contract coming out. I'm not saying that there is one coming out, I'm just saying I wish there was. A little bit of history. Going back to the mid-1990s, this gives you a quick historic chart of the Nifty index and broadly how it's performed. As I want to repeat here, past performance is no indication of future results, but it helps to understand history and take a look at how this index has performed in different cases. Here you see the two big drawdowns for that in the 2008 global financial crisis and most recently in the COVID crisis. As of this screenshot in late May, the Nifty was still well below its highs earlier this year, for comparison. Now, of the top 50 Indian names, you may be asking, where else can I trade these? Where else can I access them if I'm not an Indian resident and I can't buy Indian shares directly? Well, of the top 50 names, this table gives you an idea of which of them have ADRs or GDRs traded on overseas exchanges, and which ones also have SGX-listed single stock futures that you can also trade. Back in December, I did another webinar specifically on Indian single stock futures traded on SGX, which you can go long or short on individual names. They are unfortunately not terribly liquid once you get away from Reliance, but Reliance and Axis Bank, they both have GDRs listed in London, which you can trade, and 6 other names have ADRs listed in New York that you can trade during US hours. Out of the top 50 names, that's not really a heck of a lot of selection. So if you want a more diversified portfolio, you're really looking at either an ETF or an index futures contract until we start seeing more ETFs listed or something like Stock Connect or some other way of accessing these shares directly. So one of the reasons I'm talking about the index is, as someone who doesn't have direct access, that for some of these names, it's my best way of access. Of all these names, it probably won't surprise you, one name I'm especially interested in, because there isn't even a single stock futures on it, is Nestle India. I tend to be quite interested in Nestle subsidiaries because I like consumer packaged goods. They're easy businesses to understand. You can go there and you can see exactly how they're operating in different markets. You may have also seen my interest in Nestle Nigeria in other articles I've written about elsewhere. So of the top 4 names in the Nifty index, I wanted to chart not just their price performance, but their net income performance. Now, in order for me to do this, I had to look at companies that had ADRs, because that's the only type of company which YCharts has data for. So for those companies, as we can see, that other than ICICI Bank, they're pretty steady on both their bottom line net income and bottom line net income growth. And if we want to look at India as a growth story, we don't just want to see top-line economic growth and broad economic growth. You really care as an investor, is the dividend that you're getting back or the bottom-line earnings going to be returned to you as a shareholder, is that going to grow over time too? Ideally, you would want to buy a company where your dividend in 2050 every year is more than what you paid to invest in the company in 2020. That's the dream dividend growth investment. So you want to look at the bottom line, at dividend growth, at net income growth, and factors like that. Now, growth is one thing. I'm very much a believer in growth at a reasonable price. So the next chart, as I showed earlier, the PE ratio of the whole index, this one shows the PE ratio of the top 4 components. Actually, in this case, just 3 of the top components, because I wasn't able to get a PE ratio for Reliance. And you can see, of course, it fluctuates, really based more on the denominator than it does on the numerator. But if you're like me and you like to buy low and sell high, obviously you want to find a good company and buy it when its PE or PB or other ratios are low, and be careful about buying it when its ratio is relatively high. When you're looking at the index, though, you're going to have to do that on a weighted average basis rather than on an individual name basis. Another way I like to look at valuation is not just by looking at trailing 12 months earnings, but by looking at something called the cyclically adjusted PE ratio, or CAPE ratio. This is where we take the price today and we divide it by a long-term average of earnings. And in the case of India, you can see here a CAPE ratio that's now just back above 20. Now, by comparison, the CAPE ratio of the S&P is around 30. So India is still cheap compared with the US. It's not as cheap as, say, China or South Korea, and you want to look at that by comparison. This particular chart by Sibylist Research also shows you that in general, when you buy at a lower CAPE, your 3-year forward expected returns on the index tend to be higher as well. So the CAPE isn't as high as it was in 2008 when 3-year returns were the lowest that they've been over the past 20 years. This may or may not provide you a good indication, but I highlighted it as a number that you may want to look at when deciding whether you want to make a bull case or bear case for the Nifty. Now on to the futures contract. This is a screenshot, like I showed you earlier for the Indian rupee futures contract. This is the screenshot for the Nifty 50 index futures contract. And here I'm showing you the snapshot of the June and July for both the T and the T+1 sessions. Really showing you that, once again, most of the volume is in the T session, front month contract, still significant volume in the T+1 session. At least when I took the snapshot back at the end of May, there wasn't a heck of a lot of volume in the July contract just yet. But of the index futures contracts traded in Singapore, it probably won't surprise you that India and the Nifty 50 and A50 are 2 of the most liquid ones. So if you're outside of India and you want to trade India index futures, this is still the place I've got to go. And I'll show you some of the strategies that I use for it later. Again, I wanted to show the shock test for how this performed earlier this year. So like a lot of other equity indices, back in March, we saw the value of the Nifty index collapse by, I forget the exact percentage, 30, 40%, but a significant percentage, like a lot of equity indices. Traders who were really, really gutsy and they bought these futures contracts below 8,000 were really, really lucky, or those who got short above 12,000, made a lot of money. So it's swung a lot since then. It's back around 10,000. But again, I show these mostly to give you an idea of how this particular index handled the shock test earlier this year, and where on the SGX chart you can pull up the history of the index. On to the specific specs of the contract. The multiplier of this contract is $2 US per point. That means that if I bought one contract at 10,000, it has a notional value of $20,000 US. It would use up about $2,500 of margin. So quite a bit of leverage there. Those of you who know my futures trading strategy know that I do not like to push margin limits at all. If I'm going to do this in an account, that account is probably going to have over $10,000 in it. So a lot less than 2-to-1 leverage. I'm definitely not going to want to push limits. That way, if we have another March, I don't want to be in a position where I'm going to get margin called. This particular screen shows a buy trade. You could just as easily do a sell trade if you're doing a strategy where you're, say, buying a select portfolio of ADRs and shorting the index, or going long Nifty banks and short the Nifty index, or something like that. But once again, this is the screen for what a buy or sell ticket on a Nifty index futures contract is going to look like. So what is the difference between trading a stock, if you happen to be an Indian resident and can buy Indian shares directly, an ADR on the London Stock Exchange or New York Stock Exchange, or a P-note, an offshore access product, which can give you access to individual Indian names, which, by the way, I've mentioned, that's another institutional way if you want to get access. Well, those are all things that you buy with cash. So if you want to buy $20,000 of those, you put up $20,000 worth of cash. If you want to sell them short, you've got to borrow them to sell short. And you can borrow and sell short ADRs in New York or London. From what I understand, you cannot really borrow and sell short in India, and SEBI will get very hard on any counterparty which will let you short Indian stocks via P-note. So very much like the mainland China A-share market, it's a tricky market for any kind of short positions. And that's what I'm going to highlight later, what makes having an offshore futures contract quite compelling. Now, the nice thing about these cash products is if you go long, if I buy, let's say, the Wipro ADR, I can hold it as long as I want. I don't have to sell it. I don't have to roll it. I don't have to trade it. I can just buy it and hold it for 10 years. But I am buying usually something traded in dollars or traded in a foreign currency that has a Indian rupee underlying asset. So if I'm buying, let's say, the Wipro ADR in New York in dollars, the underlying asset is still the Wipro company whose profits are in Indian rupees. So you may want to look, if you're worried about that, you may look at a strategy where you buy Wipro shares and you sell Indian rupee futures as a hedge. You can separate that out. But it's just something, I'm not saying you should do it. I'm just saying that's something you should be aware of if you're concerned about currency risk. The other question, of course, is dividend tax issues. If you are a foreign investor and you invest in India, there's generally withholding taxes on dividends coming out of India. And in general, I say you want to try and minimize the number of times that dividends cross borders. You don't want to have cases where a dividend goes from here to the U.S. to a fund there and then comes out of the U.S. and there's withholding taxes every time it crosses the border, especially if you're a dividend investor. That will eat a lot into your return. Now, by comparison, futures contracts have a relatively small margin requirement. I showed you earlier that for roughly $20,000 of India exposure, you're going to be using about $2,500 worth of margin. Again, you don't want to push it because if it moves against you, you will get a margin call and you'll lose a lot of money. Also, to sell short, you don't need to borrow. All you do is you click sell and you sell a contract, and done, you have a short position. You're using margin again, but you are not actually borrowing and you're not explicitly paying margin interest the same way you would when you borrow securities to sell short. Now, a disadvantage of futures, if you're a long-term investor, is that you can't hold them for years. If you trade the Nifty futures, you're going to have to plan to roll them monthly or quarterly, at least. Same exact thing really with the Indian rupee futures contract as well. Now, in terms of currency exposure, if you buy the Nifty futures or sell the Nifty futures, you may have noticed that that contract is denominated in US dollars, and it's $2 per point of index. So that is an index for an average of stocks denominated in Indian rupees. And if the Nifty goes up 1%, doesn't matter why it went up, if it goes up 1%, that's an average of stocks that trade in rupees. You're going to make $2 US per point. It's basically just looked at the value of the index and it charged you or credited you US dollars for movement in that index. That is called a quanto. That means you do not directly have that Indian rupee exposure. And there's a plus and minus to that. You can imagine if the Indian rupee were to collapse and the Nifty index were to rise because of devaluation of the currency, that would actually be great for someone who had a long position in the Nifty index, because the Nifty index would go up and you get paid that in dollars and you wouldn't be affected by the currency position. So again, I'm not giving you a direction there on which way the rupee is going to go, but I want you to be very, very aware of what that currency exposure is. And in terms of dividend or other tax issues, that's all basically priced in. For many investors, you're not going to see any withholding taxes or other cross-border taxes when it comes to futures contracts. You trade these futures contracts in Singapore, the index goes up, dollars get credited to your account, the index goes the other way, dollars get taken from your account. It's really that simple. And when you roll the futures contract, you'll see the difference between the June and July. That will pretty much reflect whatever dividends would have gotten paid in the meantime, kind of net of whatever tax your counterparty would have priced into it. So that's what I mean by dividends are priced into those futures contracts. Now, another example of a long-short strategy I want to mention is doing a trade of ADRs or ETFs versus a futures contract. So let's say, for example, those 8 ADRs or GDRs that I mentioned to you earlier. Let's say that you think those are the best, you want to buy those, and you want to short the index, or vice versa. But that's just one way of doing it. You buy the ADRs, you short the futures as a hedge, and you try and capture the alpha between them. So it lets you select individual names or perhaps an individual ETF or fund, perhaps an actively managed fund, if you believe that that's going to outperform the index. And it's going to let you hedge out the overall beta exposure of the index. In terms of your long or short position in the futures contract, as I mentioned, everything having to do with custody, dividends, corporate actions, all of that is built into the futures contract. And the only thing the futures contract leaves you with is whether the index goes up or down. The futures contracts in that way are very, very simple. The key risk to watch out for, if you're going to do exactly what I said, let's say, for example, you buy a Nifty ETF and you hedge it by selling a Nifty futures contract, remember that you are not perfectly hedged. You are still basically exposed to the Indian rupee currency difference between those two. Because if the Indian rupee goes down and the Nifty futures doesn't move, your ETF position is going to go down, but your futures contract is not going to go down, because the Nifty is only going to track the index. So that's something to watch out in terms of the currency mismatch, and something to watch out as a risk factor. Now, other risks that I want to mention on the right side are, if you do this long-short strategy, you're exposed to name selection. You are no longer just trading one index, the index as it is. You are picking and choosing. One member of the index is going to outperform another. You also could have liquidity or time zone mismatch, because if you're trading ADRs that trade in New York, and then you're trading in the T session of the Singapore listed futures, those are going to happen at different times. Now that said, when you have the T+1 session, that hedging of ADRs might be one reason that you see some of that volume in the T+1 session. I mentioned earlier, and I just want to repeat a third time, a collapse in the Indian rupee could mean a rise in the Nifty index. And if you have an opposing position in the Nifty index futures contract, that is a risk factor to watch out for. You also have to be careful. Anytime you sell something short, you can lose more than 100% of the notional value of what you've got. Let's say, for example, you shorted the Nifty index below 8,000, and then the index rallied like crazy and it went up to 17,000. Well, you would lose a lot more than just the initial notional value of what you have. So be careful with that. You also, of course, have to manage your margin. So I mentioned earlier the initial margin is 2,500, but that can get wiped out very, very quickly if the index moves against you just a few points. So do not trade futures unless you understand terms like limit up, limit down, initial margin, maintenance margin, And I presented this really with the idea that you understood what those are, but hopefully that's clear to you if you know about futures and want to learn more specifically about these two futures contracts. Well, I realized we're just about to hit 1 hour on this presentation. I want to make sure I give you a chance for the title slide. Here is my contact information, my website, my WeChat QR code. You can also follow me on Seeking Alpha. I do write several articles on really many names globally, including names on India. I wanted to make sure that I got some time to address questions before we finish off here. And I'll go ahead and I'll leave my contact information here if you would like to get in touch. One thing I will repeat is that my firm, my US firm and my Hong Kong firm does have an advisor account on Interactive Brokers. So one of the things that we do is we do professionally manage either entire Interactive Brokers accounts or partitions of Interactive Brokers accounts for clients who have specific needs that they need our help with. So with all that, I'm going to quickly go to questions and see what questions we have for, oh wow, quite a few here. All right, okay, trading Forex contracts, okay, for an trading senior services. Okay, this is so the first question I have is a regulatory question that is asking about whether an Indian resident can trade some of these contracts. I admit that I am not an expert on these regulatory issues. What I will say about these contracts as I have seen them is that I only manage offshore accounts. I manage accounts that are either based in the US or based in Hong Kong. Some of my clients, might have a base in India or might be based overseas, but I don't specifically address regulatory or tax issues, and I'm not sure if that's something that anyone else can answer. I'd like to answer some of the other questions first, and then possibly get back to that later. So question number 2, I've got another question from an Indian resident. Is there any option to trade Forex futures contracts? So again, I can't speak to what is available to Indian residents specifically. What I have mentioned, these SGX futures contracts, I have traded in Interactive Brokers US accounts, and I've traded in Interactive Brokers Hong Kong accounts that I manage under my two different entities. We don't have any of those for Indian residents because I know Interactive Brokers, I believe, has a different entity for Indian residents that allows Indian residents to trade Indian cash equities. So if you want to send me a follow-up question on that, I can try and see if I can find out, or maybe we can find out with Interactive Brokers. But I'm speaking again as an independent advisor. I can't speak for Interactive Brokers or Singapore Exchange. Okay, now I've got a more general economic question. Will the Indian rupee ever get to full convertibility? What is the government of India scared of, or why are they reluctant to make INR fully tradable and convertible on the open Forex market? So I have to admit, this is quite a speculative question. I really can't speak for the Reserve Bank of India. I really can't speak for the Indian government. What I can generally say from my study of emerging markets is that the reason that many emerging market economies control their currency is that they're trying to prevent capital flight. They basically feel that their economies are still too small relative to global capital markets and global currency markets to avoid attacks of sudden capital flight leaving their economy, which the main example I often point to is the Asian financial crisis, where a sudden stop and capital flight really damaged many economies of Southeast Asia. And if you're thinking of Thailand and Indonesia in the late 1990s. Now, as far as managed currency goes, there are a wide range of those. You could say, will Indian rupee go to full convertibility? You can ask the same exact thing about the Korean won or the Chinese yuan renminbi or a dozen other currencies. I would ask, the question I ask is someone based in Hong Kong who has seen the move to an offshore renminbi market, to renminbi accounts in Hong Kong and London, is will we start seeing even that development of an offshore rupee market, perhaps controlled convertibility, perhaps baby steps, rather than just a sudden move to full convertibility? A few examples that you might look at if you're very optimistic about India would say be Australia. In the 1970s, the Australian dollar wasn't fully convertible, and that was something that had changed quite a bit later. And I'm not exactly saying that India now is like Australia in the 1970s, but that would be one case I would look at if I were trying to guess on the RBI. But from their point of view, I think really what they're looking at is, can they prevent a capital flight from delivering a massive shock to their economy, probably on the order of what COVID-19 has done. And I'm not in a hurry for that. I would instead like to see something like Stock Connect and offshore rupee accounts. Oh dear, looks like someone has lost the audio. Hopefully you'll take care of that there. Okay, are figures of GDP per capita adjusted for inflation? I have to admit I'm not 100% sure. I believe they are purchasing power parity, and purchasing power parity usually does adjust for inflation. But that's an excellent question. I would want to go back and double check. Thank you very much for that question. So question again, I've got another question. Okay. How much one Nifty 50 costs in US dollars? I don't know if what you're talking about is number of US dollars notional for a Nifty 50 futures contract. In that case, what I showed earlier was every point of Nifty was $2 US. That's the current contract spec, which meant that at $10,000, you're talking about a $20,000 US notional size for a Nifty futures, long or short. And you saw the margin contract. That's pretty much a contract spec, and that's really what I look at when I determine including it in a portfolio allocation. If I've got $1 million portfolio, I want a 2% allocation to India. That's one Nifty futures contract. Okay, how much do I charge for my advisory services? I have 3 different fee models for our firm's advisory services. One is a percentage of count model in cases that we manage accounts on a fully discretionary basis. Another is percentage of profits model when we manage accounts and we basically are entering a long-term partnership to share profits with clients whose accounts that we manage. And a third, more ad hoc model is an hourly model, usually when we're doing a very, very specific job and a client wants us to send an invoice for, let's say, 5 hours of work, and I have an hourly rate I can share with you. If you'd like to ask in more detail, you can send me your contact information and I can break down each of those fee structures for you. What is the Nifty option liquidity on SGX? Excellent liquidity. Excellent liquidity. Excellent question. I haven't traded Nifty options yet. I've been busy enough just trading the futures, and to be fair, we have a relatively small allocation to Nifty because of the lack of single stock access. Good question. Next time I look, I will let me know. I will let you know. By the way, just to answer that is something I'm probably going to be looking at within the next 6 months, because when volatilities are high, we tend to be more and more interested in covered call strategies. So in accounts where we have India exposure through futures, that is one where we're probably going to be looking at covered call and other strategies like that. How can we trade SGX options? Okay, yeah, there was another question about options. Thank you. Okay, so there's a question specifically in the ICT sector in India, and I think that's information communications technology. So really there, what I'm thinking of are individual names. I don't know how much more you can do on further research other than looking at the individual names that you can trade depending on whether you're Indian resident or non-Indian resident and breaking it down that way. I'm not sure if that really answered your question, but again, when I typically jump from overall index to individual name, I don't spend a lot of time just at the sector level. Okay, there's a question here about minimum sizes. This is really, I would say, just a general question having to do with what initial margin means. My understanding is that if you have enough in an account to open an Interactive Brokers account, so you meet Interactive Brokers minimum, and you have more than the initial margin on a futures contract, that will let you trade a futures contract. But what I was trying to warn on the initial margin is that if the initial margin is $2,500, you don't want to have just $3,000 or just $5,000, because even though you could, in theory, trade a futures contract with that amount of margin, what it means is that if the index moves a few points against you, you're going to get a margin call. And that's a kind of risk that I really warn your early futures traders about, and is very, very important to futures risk management. Now, here, of course, you're talking about futures with lower limits. Usually, I often look at it progressively. For accounts that start closer to the Interactive Brokers minimums, usually I'm starting with ETFs or a few individual shares, building them up over time, and then once those accounts get larger, we're really talking about futures once we're talking about larger accounts. Okay. I have another question, specifically about fund management. That's another one that again I will take offline. So wow, thank you, I will say, for all of your questions, and thank you for those of you who've attended and passed the 1 hour mark with me. I know I sometimes can speak a little bit quickly, but I do feel it was important to try and cover as much as I could about India, both in terms of the current COVID-19 situation and the long-term outlook, at least as I've stretched out from the PwC report. Thank you again to Cynthia and the Singapore Exchange for joining me on hosting this. And Cynthia, if you're still there, I'll hand it back to you.
Well, Tariq, thank you so much. Terrific presentation today. Now, by the way, if you would like a copy of the slides, notice that we do have a handouts panel that's located on the right-hand side of your screen, and you can download those directly before you do exit today's session. By the way, we have been recording as well, and each of you will get a direct link to today's recorded playback, as well as a PDF copy of the slides in use today. So with that, I'd like to thank the Singapore Exchange, our partner exchange, for making today's presentation possible, and for Tariq for all the work that you've put into the presentation. And I'd like to thank all of you for your participation with us here today. This is going to conclude our session, and want to remind you to watch your inbox if you want to come back and review the concepts that Tariq did discuss. So have a great rest of your day, everyone, and thank you. You can exit using the X in the upper right-hand corner of your screen. Have a good one, all.